Hi.
Connor, Annetta, Paulina, Yillen. How you guys doing?
Good. How are you?
Good.
I'm good as well, thank you. How are you, sir?
I'm doing fine. I've got a hoarse throat. Not a sore throat. I'm not even getting sick. I'm getting over a bronchial infection. I do not have the virus.
Oh,
But
that's not good.
I have an irritating sounding voice for you to listen to. I apologize for that. Hey, Kayla.
Hey.
I'm just saying hello to everybody as they join the class. That reminds me. one per student's Mac totally crashed. I need to contact him and let him know he could literally do this with his cell phone. So, Macy, good morning. Still morning by 5 minutes. While I have the few of you, let me ask you a question. I have voiced over PowerPoints for everything I teach but this class. And I've been using the Zoom recordings of these meetings as sort of a substitute. But if I could fashion some voiced over PowerPoints, how many of you would much prefer that? All right, Macy, I'll do what I can. I've got 2 graduate classes, 2 undergraduate advanced classes where I've had the voiced over PowerPoints set up for a good while. I've just never taught this course online, so I never set up voiced over PowerPoints, but I may be able to take what I have, pare it down, edit it, and create some for you. I will try. No promises because my skill set's limited. Bryce, Elisa, James, good morning. It's still morning, but 3 minutes. And Sam. Sam, you're the only one I'm getting a video image from. And actually, it's not necessary for me to see you. It's necessary for you to see me. So you can see the PowerPoints and all my doodling on the whiteboard. But I do like to see 1 or 2 faces. You know, just on occasion, I'll ask a question and ask for somebody to raise their hand if they hear me, you know. And again, sorry about my voice. Losing my voice a little bit, but I think we can muddle through this. What are your profs doing for your other online classes? Are they doing pretty much what I'm doing, or are they using voiced over PowerPoint recordings? Or
I have a few that are doing the PowerPoint, like the voiceover lectures. And then I have one who's not doing anything. He's just like making us do work out of a book, but that's about it.
For the voiced over PowerPoint, is it interactive? I mean,
no,
or does he make a recording and then you go watch it?
That's what it is. They make recordings and we go watch it, which is like helpful because you can pause it. And like when you need to like research
You realize once this recording is recorded, you can also pause it.
Mm-hmm. I go watch them too.
Okay. Well, all my timepieces are telling me it's high noon. So, did you guys get my slides for chapter 3? That was a glitch because I had other people covering the class. But I don't normally cover those till I get into this chapter we're in. So, all right, here we go. We are in chapter 9, dealing with Well, we started with the dividend model, and we had one other little thing left to cover with it. The value of preferred stock. Common stock and preferred stock are alike, except for one thing. If you buy a share of preferred stock, and it's usually your regulated monopolies, Western Gas, Energy Electric, Con Edison Electric, they're the ones that sell preferred stock. And the difference between preferred stock and common stock is with preferred, your dividends never get bigger. They stay the same. So the growth rate in dividends with a preferred stock model is 0. Just like the growth rate in your salary would be if you never got a raise. Stay the same. Now, with our common stock model, it looked like this. The value of our common stock was the dividend in the coming year divided by the stockholders' required rate of return minus the dividend in the coming year, or you could rearrange it if you wanted to solve for rate of return. Now, what we do with preferred stock is it's actually much simpler. We use the same model we use for common stock, only we change some of the little symbols. You know, with common stock, your dividends grow. With preferred stock, they don't grow. And since they don't grow, we don't bother with the subscript, the time subscript, because they're all the same. D1 and D0, D2, they're all the same. So with preferred stock, the model looks like this. It's the dividend on preferred stock divided by the preferred stockholders' required rate of return. I was getting a lot of feedback, so I muted some mics. Maybe you weren't hearing it, I was. And likewise, the rate of return on preferred stock would be the dividend, what's an ugly day, over the price. So for example, in your slides, you've got an Entergy preferred. And let me get rid of the stuff on the left so I can have some room. For Entergy, in your slides, you're given the following information. You're told the dividend is 8% of the par value. That'd be $8. And by the way, with corporate bonds, the par value of all corporate bonds is 1,000. Not true with preferred stock. Some preferred stocks have a par value of $50, some 25, some 100, it varies. It's not standard. And we're told that the preferred stockholders have a required rate of return on energy of 10%. So the question is, one question is, What's the value of energy preferred? And I'm going to add another one. What is your expected return if you pay, I don't know, let's say $60 for the preferred? Now, if you'll notice, we use this form of the preferred stock model to come up with a value. So the value of the energy would be the dividend of $8. And since this is an algebraic present value function, just like your dividend model, interest rates have to go in decimal form. And we'd come up with a value for the energy preferred of $80. And likewise, if you could buy it for 60, your rate of return would be the $80 over the 60. And that would give you a 13.3% rate of return. Are you with me on this so far? I can't see anybody. Oh, well, okay. Yes, thank you. I love that. All right, let's try another. Just to see if you're getting it. Look, the preferred stock thing, it's the easiest thing we cover in the whole course. Forgive me while I do this a long way. I'm sure there's a shorter way, but my skill set's limited. All right. What? Western Gas. Preferred. Pays a, well, I don't know, a $4 annual dividend. Question A. My little Microsoft Surface is misbehaving, but let's see. If you require an 8% return, what is the most you should pay for the stock? And B. Sorry. If you buy the stock for $40, what is your expected return? take a quick second and see if you can come up with that. I'll do some housekeeping while you do that. Did you get $50 a share for what the stock would be worth? I got to figure out how you show those hands so I can do that. And for the rate of return, if you buy it for 40, did you get a 10% return? How many of you got those two figures? How many of you got those figures? Good. Okay. Thank you. Really, that's it on preferred. Now, I sent you slides for chapter 3 today. If you have them, great. If not, don't worry about it. I'll go over it fairly slowly. But I had told you at the start of chapter 9, the stock equity valuation chapter, we'd use two big models. One was the dividend model. We've pretty much finished it. The other was called the corporate valuation model. But the corporate valuation model, instead of focusing on dividends, it focuses on something called free cash flow. And we learn about what free cash flow is and how to calculate it back in chapter 3. So if you will, pull out your slides for 3. Don't worry about this. I'll get to this in a second. These are the financial statements for MD Corporation for the last 2 years. The balance sheets, the income statements. Now, to come up with free cash flow, it's a building process. First, you calculate something called net operating working capital. Oh man. Sorry. My. Working capital. Oh, golly. Guys, it's not supposed to be responding. This is a Microsoft Surface. It is not supposed to respond to the touch of my skin, but it is. Working capital is current assets minus current liabilities. With net operating working capital, it's calculated the same way, except we kick out interest-bearing items. Marketable securities pay interest, but we leave it out. Notes payable, we pay interest on, so we leave it out. What we're really trying to come up with is a measure of working capital more directly tied with operations. Well, if you think about it, the current assets other than marketable securities are cash, receivables, and inventories, and those automatically go up and down with the level of operations. If a company's sales go up, it carries more cash, more receivables, more inventories. And likewise, current liabilities has two items directly tied to operations. Accounts payable, which is what you owe your suppliers, and accruals, which are accrued wages and taxes. So if a company's sales go up, it automatically buys more from its suppliers, so accounts payable goes up. It employs more workers, so accrued wages goes up. It makes more profit, so accrued taxes go up. So what we're trying to do is, with net operating working capital, get a measure of working capital investment directly tied to operations. Now, if you'll look at the balance sheet, the left-hand side for 2020, we've got current assets of 1,037 and marketable securities of 37, which we subtract out. If you look over on the right-hand side for 2020, we've got current liabilities of 310 and notes payable of 110, which we subtract out. So that leaves us with net operating working capital of 800 million. We then calculate something else called operating capital by simply adding net fixed assets to net operating working capital. If you ask an accountant, what's the company's investment in operations, they quote total assets. If you ask a finance person, what's the investment in operations, they quote operating capital. That's how we measure how much we have invested in the operating side of the business. Then we also have a different measure of profit. It's called NOPAT. That stands for net operating profit after taxes. All right, I'm going to try this. That's what net income would be if the company had no debt, without debt. If you'll notice, EBIT stands for earnings before interest expense and taxes. And what we're basically doing is we're not subtracting interest expense, which means we're ignoring it. We're treating it as if the company has no debt. Just as we took interest expense out of our investment, we're taking it out of our profit measure. So for 2020, NOPAT works out to be, well, EBIT is 300. If you look at the left-hand side of your income statement, that left column for 2020, EBIT is 300. Our tax rate's 40%, so we end up with an NOPAT of 180. That's how we measure the profit after taxes from operations. Then finally, to get to what we're after, free cash flow, we take NOPAT minus the change in operating capital, how much the company expanded. And I forgot to give this to you, so I will here. Let's just say that it's given that operating capital in the prior year, which would have been 2019, was 1455 mil. So, plugging it in, we've got 180 mil we earned from profit after taxes, operating profit after taxes. But our operating capital expanded by 345 mil. So here's my question. Did we make enough in profit from operations to pay for the expansion? I know you've got the yellow hand or thumbs up if you agree. Do you have something that says you disagree? Just curious. Okay, obviously, if we made 180 million in profit from operations, but we expanded operations by 345 million, we fell short by 165 million. That is our free cash flow. Now, what does that mean? That means we had to borrow more money or sell more stock. To come up with that extra 165 million we needed. Now, this is important. Is a negative free cash flow a bad thing? Not necessarily. When companies are growing like mad, what they spend for expansion is way above what they're making in profit at the time. Like Amazon. Amazon's free cash flow over the last few years has to have been negative because they've been expanding so rapidly. Now, we don't want free cash flow to be negative forever, but for a rapidly expanding company, it's normal, and it's not necessarily a bad thing. In fact, often it means, like with Amazon, good things are happening. They're growing like mad. Now, just for grins, find net operating working capital, NOPAT for the prior year. Oh, I forgot. There we go. And free cash flow. And let's assume it's given that operating capital in the year prior to 2019, mainly 2018, was 1405 mil. Guys, I apologize for all the glitches. I'm using a Microsoft Surface. The Surface is not supposed to react to the touch of my skin, my hand, but it is. Take a minute and see if you can come up with those figures. Of course, you'll need to look at your financial statements for 2019. And I'm pausing while you do this. Shameful, but I'm not all that patient. Okay. I may have done that too quickly, but did any of you get my figures? Can anybody show me a yellow hand or something that signifies, Garrett, good, thank you. You know why I ask you? I make mistakes all the time. If you get my figures, that means I didn't make a mistake. So, or we both made the same one, which is very unlikely. Okay. What does the positive free cash flow mean? Was the company able to pay for the $50 million expansion internally from its operating profit? Yeah. Was the company in 2019 forced to borrow more money or sell more stock to cover the cost of its expansion? No. It made enough internally to pay for the expansion. Now, this is what we came for out of chapter 3. But as long as we're here, there's one other kind of neat measure based off of all of these. And it's something called EVA. I learned, well, EVA stands for Economic Value Added. I taught in an executive MBA program down in Mandeville a few years ago, and all my students were corporate execs. They taught me about EVA because it was how they were evaluated. If you'll notice, the formula looks a lot like free cash flow. You got the notepad on the left and you got operating capital on the right. But with EVA, the notepad stands for the actual operating profit of the company. And the WACC is the rate of return the market expected the company to earn on its operating assets or operating capital. Operating assets, operating capital are interchangeable terms. So for example, let's say that in 2020, the market expected the company to earn a 12% return on its operating assets. If you recall, we already found that EVA was 180. And its operating assets were 1,800 mil. So 12% on 1,800 would be 216 million. The 180 is what the actual operating profit was. The 216 million is what was expected. Did the company's operating profit meet, exceed, or fall short of expectations? Fell short, didn't it? The market thought they were going to earn over 200 mil. They earned 180. In fact, how much did they fall short? That's what EVA is. They fell 36 million short. Is that necessarily a bad thing? Yes. What happens anytime a company announces its profits, and then they announce that fell short of analysts' expectations? They like to use the phrase guidance. Profits fell short of guidance. What happens to the stock price if the actual earnings announcement is a disappointment? Stock price goes down. Is that necessarily a bad thing? Yeah. Our job is to do things that make the stock price go up, not down. Now, just for grins, let's assume, actually, let me see how much of this I want to clear. Yeah, I'll clear it all and write some of it. Okay. Well, not stamp. There we go. Here's my question. What was EVA for 2019? If you recall, we already found that Notepad for 2019 was what, 120? And operating capital for 2019 was, I think it was 1455 mil. And let's assume that in 2019, investors were expecting the company to earn a 10% return. So what would our EVA be for 2019? Let's see, Notepad was 120. That was what they actually earned. And they were expected to earn a rate of 10% on 1455, so they were expected to earn over 145 million. So once again, in 2019, they fell short of expectations by, what is that, 25.5 mil? So what likely happened to the stock price in 2019 when the market expected them to earn 145.5 and they only earned 120? What happened to the stock price? It likely fell. Actual earnings were a disappointment. They were less than expected. Again, is a negative EVA necessarily a bad thing? Yes. Typically, if EVA is negative, what they actually earned fell short of what was expected, and the stock price takes a dive. And that's not what we want to do in managing the company. We don't want to cause the stock price to go down. We want to cause it to go up. Tell me something, if you were the CEO of this company and 2 years in a row you had a big negative EVA, how secure would you feel your job is? Not so much. The board, after 2 years of negative EVA, the board might be looking to fire the CEO and find a better one. Okay. Any questions? Okay. I want you to look at your slides. Where they start with corporate valuation model. All right. That is slide number 36. Believe it or not, I want you to ignore slides 37 through 47 for now. Golly, this thing. Why? Because I hit you with problems that were too tricky in your slides. Instead, we're going to look at some problems in the whiteboard, and these will substitute for what would have been the slides to come right after slide 36. This is all about the corporate valuation model. Can't even write clearly. Oh, and one other thing. This afternoon, I'm going to create some additional slides that will mimic what I'm putting on the whiteboard. Some more straightforward problems, but put them in the PowerPoints so they'll be legible. You won't have to deal with my poor handwriting. All right, what was at the heart of the dividend model? The dividend model said a share of stock is equal to the present value of all future dividends. Well, the corporate valuation model says the value of operations is the present value of all future free cash flow. You know, in a way, since free cash flow is additional profit they don't need for expansions, you could think of free cash flow as extra cash profit. So the value of all the operations is the present value of all future extra cash profit. Now, back in your dividend model, we said that if dividends grow at a constant rate, the value of a share of stock was equal to something. Here, if we assume free cash flow grows at a constant rate, again, we'll call it G, but this will be G for free cash flow, then the value of operations, and this is going to look a lot like your dividend model. It's the free cash flow in the coming year. On the bottom, we subtract that growth rate in free cash flow. Now with the dividend model, that thing on top would have been the dividend in the coming year. The growth rate would have been the growth rate in dividends. And our discount rate would have been R sub S, the stockholders' required rate of return. But in the corporate valuation model, our discount rate is the WACC, the rate of return the market expects us to earn on operating assets. And using this model is sort of like the Texas two-step. Step one, you find the value of operating assets. Step two, you run it through the balance sheet equation. And I'll show you that in a minute. You do that to get the value of equity. So let's take a problem. Guys, I'm making this up. Let's assume that free cash flow for the year just ended was, I don't know, $50 million. The growth rate in free cash flow that we expect, 5%. For how long? Forever. And let's assume for this company, the cost of capital is 15%. So the first question is, step one, what's the value of operating assets? I'm telling you, this thing's driving me crazy. It's not behaving properly. Now, our model says the value of operating assets is free cash flow in the coming year, FCF sub 1, divided by WACC minus the growth rate in free cash flow. Was this 50 million that we were given, was that the free cash flow in the coming year, FCF sub 1, or was it FCF sub 0? It was the free cash flow for the year just ended, right? So to get the free cash flow in the coming year, we increase it by the growth rate. Just like we did the dividend. So our free cash flow in the coming year would be this 50 mil times 1 plus, what was the growth? 5%. $52.5 million. So free cash flow in the coming year is $52.5 million. Our cost of capital is 15%. Our growth rate is 5%. So we believe the value of the operating assets right now is $525 million. That's the present value of all future free cash flow. That's step one. Now, step two is we run this thing through the balance sheet equation. If you recall, the balance sheet equation says assets are equal to liabilities plus equity. Accounting 101. However, with a corporate valuation model, we separate assets into two categories: operating assets and non-operating assets, which are really just the marketable securities. And likewise, for liabilities, we only include the interest-bearing liabilities, because earlier, to come up with free cash flow, we started by subtracting accounts payable and accruals. In other words, we've already accounted for non-interest-bearing liabilities in coming up with free cash flow and coming up with the value of operating assets. So what liabilities are left that are not interest-bearing? Notes payable and long-term debt. Now, I'm running out of space, so I need to do a little bit of erasing and add some stuff. Let's suppose we're also given the following information. Like I said, I'm going to create some PowerPoint slides that have these in a lot more legible form, but let's assume the following information. This thing there. Let's say the company has marketable securities of 50 mil. It's got notes payable of 125 mil. It's got long-term debt of another 75 mil. And it's got 10 million shares of stock outstanding. So now we take this information, and as I said earlier, we run it through the balance sheet equation. We found the value of operating assets to be 525. Marketable securities are 50. Notes payable is 125 mil, and long-term debt's another 75. And if you notice, we end up with an algebraic equation with one unknown, the value of equity. So next step, we solve for the value of equity. And it would be the value of all of our assets minus the value of the interest-bearing debt. Let's see, 575 minus 2 would be what, 375? We believe this company's equity is worth $375 million, or on a per share basis, let's see, 375 million bucks divided by 10 million shares. We believe this stock is worth $37.50 per share. That is what we think the stock is worth. That is what we would call the intrinsic value. Just like the dividend model gave us an estimate for the intrinsic value of the stock, so does a corporate valuation model. Only it goes through a lot more steps, as you can see. So what does that 37.50 represent? It's what we think the stock's worth. If we're going to buy the stock, that's the most we would want to pay. If we can get it for less than that, we'd consider it a bargain. If we'd have to pay more than that, more than $37.50, we'd pass. Any questions before you an example to try on your own? And silence fell over the land. I'm going to be optimistic and assume you're following this, but I know you won't till you work through it a time or two. Let's try this problem. For lack of a better name and no imagination, the Zoom Corporation has the following information. Free cash flow expected in the coming year. Oh, golly. Is, I don't know, $20 million. The growth rate in free cash flow that's expected is, I'm stuck on 5%. I'll go with it again. The cost of capital for this company is 10%. This company has no marketable securities. But it's got notes payable. Let me do some quick math to make sure these numbers work out. Notes payable of 100 mil. Long-term debt of 100 mil. And it's got 5 million shares of stock outstanding. Oh, I'm hating this so much. It's not supposed to react to my scan. Okay, find the value of the operating assets, find the value of the equity, and find our estimate of the value of the equity per share. We got about 13 minutes left. Use half of it to try to crank that out, and then I'll go over it. And I'll be right back while you're working. All right. I think I'll go ahead and walk you through this. I have no patience at all. Tell me something. That 20 million, is that FCF sub 0 or FCF sub 1? If this is a free cash flow in the coming year, that's FCF sub 1, isn't it? God, look at that. So do I need to multiply it by 1 minus the growth rate to get what goes on top? That is what goes on top. FCF sub 1 is the free cash flow in the coming year. FCF sub 0, like in the prior problem, was the free cash flow for the year just ended. So in the prior problem, we had to multiply the FCF sub 0 times 1 plus the growth rate to get the free cash flow in the coming year, FCF sub 1. Divide by the cost of capital minus the growth rate. Remembering to do this in decimal form. I'm getting 400 mil. Then the value of the equity, let's see, oh yeah, balance sheet equation, right? We take the value of the operating assets plus the value of marketable securities, set it equal to the value of the interest-bearing debt, which would just be notes payable and long-term debt. And that's our balance sheet equation. So we plug in what we know. We've calculated the value of operating assets to be 400. Marketable securities is zip. Our interest-bearing debt consists of 100 of notes payable and 100 of long-term debt. So we can solve, and we find the value of equity is equal to the value of our operating assets minus the value of our debt. Well, value of our assets minus the value of our debt. Let me do it this way just to be as clear as I can. And I'm coming up with the value of the equity of 200 mil. Then to get the value of the stock per share, I take that value of the equity and divide by the number of shares. So we think the stock collectively is worth 200 mil, and with 5 million shares, shameful I can't do that in my head. $40 a share. Again, that is the intrinsic value. That's what we think the stock is worth. If we're looking to invest in the company, that's the most we want to pay for the stock. Of course, we'd like to buy it for less than that. Any questions? I'm going to create a new set of PowerPoint slides, for chapter 9. I'm going to make them much more user-friendly. I'm going to take out the tricky looking problems and put in these straight ones. I'll send them to you. We're not quite through with this chapter, so Wednesday, be sure you have your slides for chapter 9, the revised ones if you want. But also bring your slides for chapter 10, cost of capital. See this thing up here I've been calling WACC? That's what chapter 10 is all about. It shows us how we come up with it. You're all still there. I couldn't tell. Look, when I go to looking at the PowerPoints and stuff, it shows me about 4 of you. Do you have any questions? Anybody? Okay, after that long, embarrassing pause, I'll dismiss the class if that's okay with you. This meeting we had today, I'll get back from Zoom tonight. I'll probably upload it to YouTube tomorrow. By tomorrow afternoon, it should be available to you. And I'll put the YouTube link on the Moodle webpage. I will also try to get to you a revised set of slides that are more user-friendly with these simpler, more straightforward problems like the ones that will be on your final exam. Okay, y'all stay safe, and I'll see you Wednesday. Bye-bye.